If you're buying stocks and shares and investing your money, then I highly recommend that you do it through an ISA. Now, a stocks and shares ISA is a tax-free account that allows you to legally avoid paying tax when it comes to selling those investments. So outside of the ISA tax wrapper, you would usually have to pay a capital gains tax on the growth of your investment and also a dividends tax if that applies as well. So let's look at these taxes in a little bit more detail so that we know exactly what it is that we are saving on. And before we do this, I just want to make it clear that you're only paying tax on the growth of your investments, not on the total amount of them. If you buy and sell and it makes the same amount of money, or if it makes less amount of money, then you don't have to pay tax. It's only on the increase in the price of your investment. So firstly, capital gains tax. Now this isn't specifically for stocks and shares, this is sort of a general assets tax, and this applies to personal possessions, some properties, business assets, and then your shares as well. Similarly, as you get a personal allowance for your income tax and your normal salary, you also get a capital gains tax allowance as well. And in the tax year 2021, that allowance is £12,300. So this means any growth that your investment has made over the amount of £12,300, you will then have to start paying tax on it. And the amount that you pay depends on what rank of a taxpayer you are, if you're basic or higher, but it's between 10 and 20%. The second tax is a dividend tax, and a dividend is a small payout from the company that you have invested in as sort of a little bit of a thank you, and this can be paid either monthly, quarterly or annually. The dividend allowance is £2,000 for the current tax year, and like the capital gains tax, the amount that you pay in tax is a little bit complicated to calculate, but I will put up just the basic chart here. Now I know these seem like some really high amounts of money, and you're probably thinking, I'm never going to get to that amount of money, it's not going to affect me. You might be surprised to see how quickly the amounts can add up. Obviously the point of investing is that we hope to see growth, and we do hope that it makes a lot more money in the long run. Even if you are investing very small amounts of money on a monthly basis, or perhaps just one lump sum and then leaving it to grow over a long period of time, I'm going to do some calculations so that you can see how much you can expect to see. So for my example calculations, I've left it at 20 years. I think this is a good amount of time because it's long enough to be long term, but it's not too long. So if we use £10,000 as a lump sum calculation, we leave that for 20 years, and if we use the average growth of 5% a year, then that actually gives us a growth of £16,000 at least. If we stick with £10,000 and up the annual growth, if we make it 9.8%, which is the average of the S&P 500 index fund, then you can actually expect to see over £54,000 in growth. Now if you're not quite at the stage where you can put away a big lump sum like that, maybe you're doing monthly, let's do some calculations for if you were to do just £100 a month, because I think this is quite achievable. So if we do £100 a month over a 20-year period, and again at 5%, then you can expect to see over £16,000 in growth. And if we up that to again 9.8%, the S&P 500 average, then you can be making £46,000 in growth. So even if you put away £100 a month at 5%, which is relatively low, then you would still be paying tax if you were to sell them all at the same time. Now obviously there is a way around this in that you could sell them off slowly every year, so don't go over your £12,300 growth limit in every tax year, and that will enable you to not pay tax on them. But I think this is a little bit restrictive. Say you need a big chunk of money to put down for healthcare or a care home in your old age. You don't want to be restricted with taking the money out and then having to pay tax because you need the money at that time. In my opinion, it's much better to be safe than sorry, and if the ISA exists, I think you might as well put your money in there. Obviously you also have your ISA allowance to consider as well, as you're limited at £20,000 as to how much you're allowed to put into ISAs in every tax year, and this is across all 4 of your ISAs as well, so you have to consider if you have any other ISAs open that you're wanting to pay into. If you're not sure about what the ISA allowance is, then check out my video on ISA allowances that I've done, because I talk about that in a little bit more detail there. Another thing to point out is that you can open a lifetime ISA, which is a stocks and shares ISA as well. So with the lifetime ISA, you can either open it as a cash ISA or as a stocks and shares ISA. And with a lifetime ISA, you are allowed to either withdraw the money for a first time property or once you reach the age of 60. So this is more limited, but you do get a lot more benefits with it, as the government pay you 25% of whatever you save. And the lifetime ISA is limited to only £4,000 a year, leaving you with £16,000 for the others if you were to use this. So with the stocks and shares ISA, you have to be at least 18 years of age to open one, and there are lots and lots and lots of different types of stocks and shares ISA available depending on what you want to invest in. So you can invest in single companies, you can invest in mutual or index funds, which are groups of shares put into one, and you can also actually invest in gold through a stocks and shares ISA as well if you were interested in that. Okay, I've covered everything that I wanted to. I hope this video has been helpful. As always, please do leave a comment down below if you've learnt anything new or have any questions. I'd love to hear any feedback, and please give me a like and a subscribe.